Stock markets are flashing red. US tariffs are rising. China is retaliating. Tech giants are bleeding billions. But here's what most people miss. This is how wealth is transferred, not lost. Today, we'll show you why the 2025 crash is far from a curse, and how new millionaires are already being made. In 2008, while millions panicked, a few sharp investors bought Apple at under $4. Today, it's worth over $200. Right now, we're watching that same blueprint play out again. But this time, it's semiconductors, AI chips, and American industry rising from tariffs and recession. If you can spot it, you can own it. Chapter 1. Why the 2025 crash is happening now. The 2025 crash isn't a surprise. It's a slow-motion train wreck we've seen coming since late 2024. Let's break it down. When Donald Trump returned to the White House in January 2025, one of his first moves was to slap a 60% tariff on all Chinese goods. Within weeks, China hit back with import restrictions, especially targeting US semiconductor and ag tech exports. Wall Street freaked out. Companies like Nvidia, AMD, and Intel, which rely on global demand, saw tens of billions wiped off their market caps in days. The S&P 500 dropped 12% between March and June. Meanwhile, the Fear and Greed Index plunged to extreme fear, matching levels last seen during the COVID crash. But unlike the COVID crash, this isn't temporary panic. It's structural. These tariffs are re-engineering the entire global economy. The supply chain is being rerouted. China's role as the world's factory is being challenged, and new tech frontiers like AI, robotics, and clean manufacturing are becoming national priorities for the US. And Chapter 2. Recession warning signs are everywhere. The Federal Reserve is walking a tightrope. In June 2025, inflation ticked up to 3.4%, well above the Fed's 2% target, driven by rising import costs. That forced Jerome Powell to pause rate cuts, keeping interest rates high at 5.25% even as the economy slows. Job growth is stalling. Tech layoffs have surged. Google cut 8,000 jobs in Q2. Meta announced a hiring freeze through 2025. Tesla's Shanghai factory faces shutdown threats due to export restrictions. Consumer spending is down, credit card debt just hit $1.37 trillion, and mortgage defaults are rising in Texas, Arizona, and Florida. The result? Markets are nervous, and fear is the dominant emotion. But here's where elite investors step in. Chapter 3. Fear creates opportunity if you know where to look. Warren Buffett said it best, "Be greedy when others are fearful." Right now, institutional money is moving quietly, not out of the market, but into specific sectors, while retail investors panic. Let's look at 3 key areas where this crash is minting new millionaires. Semiconductor sovereignty. The CHIPS Act of 2022 is paying off big in 2025. With tensions rising, the US government has doubled down on domestic chip production. Over $100 billion in federal grants and tax credits are flowing into companies building chip factories in Arizona, Texas, and New York. Winners include Micron, building a $20 billion plant in upstate New York. Intel partnered with the Department of Defense for secure chip manufacturing. ASML suppliers, benefiting from restricted Chinese access to EUV machines. Even though these stocks are down 15 to 30% year to date, long-term upside is massive. If you bought Nvidia in 2018 after a 40% correction, you made over 1,200% in 5 years. Made in America industrial renaissance. Thanks to tariffs, US manufacturing is surging. Companies like Caterpillar, Emerson Electric, and GE Vernova are investing heavily in American automation. Logistics hubs in Kentucky and Ohio are expanding, and steel production is booming in the Midwest. BlackRock just launched a Reshore America ETF, backed by $1.6 billion in capital. Why? Because reshoring is no longer a patriotic slogan, it's an economic necessity. AI and defense tech. As global tensions rise, AI is moving beyond Silicon Valley into defense, cybersecurity, and real-time logistics. Palantir, Anduril, and smaller players like BigBear.ai are securing long-term government contracts. The Department of Defense has allocated $12 billion for AI R&D in fiscal year 2025 alone. Venture capital firms are quietly shifting from consumer apps to applied AI in defense, energy, and agriculture. This is how today's downturn is setting up the next wealth wave. Chapter 4. Energy's Fall from Grace. Not all sectors are rising with the AI tide. In fact, energy, once the darling of post-pandemic recovery portfolios, has been the worst performer of 2025 so far. Year to date, the energy sector of the S&P 500 plunged nearly 18.9%, making it the steepest decline among all 11 sectors. One of the most glaring examples? BP, the UK-based integrated oil giant. BP's earnings have now declined in 7 of the past 8 quarters, and Wall Street sees Q2 2025 profits dropping by 38% to just $0.61 per share. That's not just disappointing, it's brutal. For long-term investors looking for value, BP's current trajectory raises serious red flags. Despite temporary price surges linked to geopolitical conflicts like the Iran-Israel tensions, BP is up a mere 2.5% year-to-date, well behind the broader S&P 500. Technically, things look bleak. BP has slipped below its 200-day moving average, signaling a loss of long-term momentum, and when compared to its historical peak of $79.77 from November 2007, today's trading level of around $30.50 is a stark reminder of how far this once mighty stock has fallen, still down nearly 60%. Chapter 5. Stocks to watch during the 2025 correction. Let's talk names, not hype. These are the stocks top hedge funds are quietly accumulating while retail investors sell. Micron Technology, currently trading around $114, down from its Q1 high of $129. Despite the short-term drop, Micron is key to U.S. memory chip sovereignty. The Idaho-based company is benefiting from both domestic policy and global DRAM demand. General Electric Vernova, spun off from GE, this new energy infrastructure firm is investing in wind, nuclear, and grid tech. Trading around $142, it's seen as a backbone for America's energy independence push. Palantir Technologies, currently at $23, this AI-powered defense software firm is under pressure due to government spending concerns, but has huge tailwinds as conflict-driven data demand grows. iShares U.S. Aerospace and Defense, a basket of elite contractors: Lockheed, Raytheon, Northrop. It's a defensive play that gains when geopolitics get rough. These aren't meme stocks, they're long-term plays riding structural changes. Chapter 6. What China is doing and why it matters. China isn't just retaliating with tariffs, it's shifting strategy entirely. Beijing has ramped up efforts to de-Americanize its tech stack, banning Intel and AMD processors in government PCs, replacing Microsoft Office with domestic software, investing over $43 billion in SMIC to develop native chip capabilities. But they're struggling. The US controls the most critical choke points: EUV lithography, chip design, and high-end fabrication. At the same time, China is dumping US treasuries, reducing holdings from $870 billion in 2023 to under $750 billion as of mid-2025. That adds pressure to US debt markets and could push yields higher in Q3. This economic decoupling isn't a headline, it's a total rewire of how globalization works. Chapter 7. Where the wealthy are moving their money. So what are the billionaires doing right now? Let's follow the money. Alternative assets are in. According to Blackstone's Q2 report, ultra-high net worth individuals have increased their allocation to private credit, yielding 9 to 12%, industrial real estate like logistics and AI data centers, commodities, especially rare earth minerals needed for chip making, tax havens, and offshore trusts. With uncertainty in the U.S. political climate, elite wealth managers are moving assets into Bermuda-based trusts, Singapore private banks, and Swiss custody accounts to hedge against domestic volatility. Family offices going direct. Instead of relying on public markets, many wealthy families are making direct equity investments into defense startups, drone tech, and climate resilience companies, owning 10 to 20% of private firms that will go public by 2028. The crash is separating noise from real strategy. It's not about panic selling, it's about positioning. Chapter 8. How you can play this like the wealthy. Even if you're not in the top 1%, you can still follow the playbook. Index selectively, not blindly. Instead of buying the full S&P 500, focus on sector ETFs like SOXX, not betundraude, ITA. These target where the action is not where the panic is. Cash is a weapon. During volatility, cash lets you strike when valuations fall. Buffett's Berkshire Hathaway is sitting on $189 billion in cash, not because he's scared, but because he's waiting to buy great companies at great prices. Avoid over-leveraged growth. High-debt tech firms without free cash flow are getting hammered. Stick to companies with pricing power, government contracts, or supply chain leverage. Watch Treasury yields and credit spreads. If 10-year yields push above 5%, it could signal deeper problems in U.S. debt markets. In that case, safe havens like short-duration bonds and gold may rally. Chapter 9. The next 6 to 12 months. What to expect. So where is all this going? By late 2025, analysts expect sluggish GDP growth around 1.1%, unemployment climbing to 5.2%, more tariffs, especially targeting EVs and solar panels, supply chain realignment, especially for critical minerals like lithium, cobalt, and gallium. But here's the key. Just like in every historical downturn, market bottoms happen before economic recoveries. That's why the second half of 2025 could be the best buying window of the decade. Chapter 10. This is how millionaires are made. Crashes don't destroy wealth, they move it. In 2020, savvy investors bought Tesla under $80. In 2009, Amazon traded under $100. In 1987, Microsoft was a penny stock. History doesn't repeat, but it rhymes for those paying attention. The 2025 crash is rewarding those who understand three things. Government action creates ripple effects. Follow the policy, not the panic. Tariffs create winners and losers bet on the industries being reshored and protected. AI, chips, defense, and energy are the new internet. Own the rails, not the passengers. You don't need to be rich to act like the rich. Use volatility as your friend. Move smarter, not faster. And remember, while most people panic, millionaires are made by understanding what comes after the crash, not what happens during it. 2025 won't be easy, but wealth isn't built in easy times. It's built when the world gets restructured. The next few months may look like chaos to the average investor, but for those who know how to read the signs, it's the greatest buying opportunity of the decade. Don't miss it.